What is up, traders? What is up, tycoons? Super excited for today's video. I have another amazing video for y'all. We're going to dive into some of the market internals, take a look at some market breadth aspects, and go over some of my favorite leading indicators in the market. And you're going to want to smash that like button, subscribe to the channel. You're not really going to find this info out on YouTube, right? The first thing we're going to look at seasonality. We're going to talk about how you can use the bond market like TLT and the tips as leading indicators for equity markets. We'll also go over how you can do the same thing with credit spreads. And then we'll break down the 4 pillars, talk about why the 4 pillars are important and why you want to monitor them. There's also some interesting things here happening with the Dow Jones Transportation. All right, we'll break that down, and then we'll take a look at industrials, okay, and their relation to the market. We'll take a look at our risk-on sectors and risk-off. We basically have some, sectors here that we built up. All right, we're also going to take a look at defensive here, right? Is the market shifting towards defensive or is it more offensive at the moment? We're going to take a look at the relationship between the skew and the SPX, why this is important, as well as the percentage of stocks above their moving averages in the S&P. We'll break down those market internals for you guys and also give a review of the equal weight S&P 500 as well as the equal weight NASDAQ. So that way, we can get a complete picture of the market before next week starts. And hopefully this, guys, helps give you a little bit more clarity heading into the week. Now, as always, the content provided on this channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. If you're new to the channel, I do want to mention I started a completely free newsletter. There's a link in the description to sign up for that. It's called Investment Intelligence, giving out free, valuable finance content related to the markets, as well as different trading strategies. And I also try to sprinkle in some trade ideas for you guys, okay? Completely free trade ideas. This was one on Tesla, highlighting the conditions we were looking for. That trade played out very nicely. Not all the trades are long ideas. Some of them are also shorts. This was one on SWK, highlighting the chart pattern, indicating where we thought price could go down. As you can see, price went down there very well, and it played out awesomely as well as that Tesla trade. So if you're fans of free, valuable finance content, free trading content, and you enjoy free trade ideas, sign up for that newsletter, get those emails sent straight to your inbox. Now, if you ever want to reach out and figure out how we do trades like this, okay, and how you're able to, use options to make really large percentage wins, hit me up on my Ko-Fi page. Okay, there's a link in the description for that. You click on the commissions page here and you guys can book a 30-minute and 1-hour session. I do those sessions every single week. You hit me up on there. We'll work on scheduling a time together that works for both of us. You can also request a specific YouTube video on the topic of your choice through that Ko-Fi platform, as well as buy a coffee for me. Okay, this is basically a way to leave a tip or donation for the free, valuable content I do put out. Now, let's talk about seasonality here. Okay, so we have the seasonality on the bottom here in purple. And you can see we start off the year with some new highs, right? The S&P 500 has been following the seasonality projection pretty well so far. Okay, getting pullbacks around the same periods where you would expect a pullback, making new highs around the same periods when you would expect new highs. And this pullback that we've been experiencing here coincides with the seasonality pullback we were expecting. As you can see, we've pretty much bottomed right around in the same area, and we're going to see if we actually can make new highs heading into the end of the year. This would put the S&P 500 closer to its all-time highs, if not potentially even exceeding them, okay? Now, seasonality is not something to live or die by. This is just a simple seasonality projection. And we're going to see if that's going to, remain relevant because so far it's been very relevant for the year, all right? And things have played out pretty nicely here when it comes to the seasonality in the market. Now, you can use things like TLT as a leading indicator for the S&P 500. And how do you do so, right? Well, what you do is you want to be able to spot the divergences, okay? So I'm going to highlight these divergences for you guys. They're already highlighted on the chart, but I'll explain them. So here we have a series of lower highs, all right? And here we have a series of higher highs. We have the TLT on top. We have the S&P 500 here on the bottom. And so there's a divergence, okay? And if you're using TLT as a leading indicator for the stock market for the S&P 500, and you see that it's making lower highs at a period where the stock market's making higher highs, this is a suggestion that the stock market needs to catch up to TLT and could be due for a pullback. Now, we saw that happen early in the year. Okay. And then throughout the middle of the year, the summer, we had this extended period again where the stock market was making these higher highs and TLT was continuing to make these lower highs, again suggesting that the stock market could be due for a correction. We topped out here in the summer, and we have not created new highs since that point. Now, we've also had some other divergences here lately, but most notably, currently at the moment, TLT is still making lower highs, and the S&P 500 has actually made higher highs, right? So this, again, is another indicator that the stock market may be due for a pullback. Now, we've already begun this pullback process, so this could be that divergence playing out. But we're going to see how this progresses and if this continues, okay? That's one thing that I'm going to be monitoring right now. Now, to do the same thing for the NASDAQ, typically you'd want to look at the TIPS. These are your Treasury Inflation Protected Securities. So we have the TIP ETF on the top, and we have the NDX on the bottom. All right. And again, you're seeing the same thing. We're seeing divergences here between the TIPS and the NASDAQ, suggesting the NASDAQ should have a pullback. Same thing over here in the summer. We get that pullback, divergence here, and divergence here most notably most recently. And again, we're starting that pullback process. Will we have a deeper correction? Let's try to dive into that some more, right? What can we look at to figure this out potentially even more? All right. Well, when we take a look at the high yields versus U.S. Treasuries, that's going to be our chart on the bottom. And this is basically a measure of credit spreads. Okay. We're also seeing, divergences here as well. So you have the S&P 500 on top, and then you have our form of measuring credit spreads here on the bottom. And you can see when these have divergences, oftentimes they can be leading indicators for each other. Okay. It's not always going to go one way. So in this case, we see our credit spreads making lower lows here. Meanwhile, S&P 500 making higher highs, suggesting that one of these needs to correct itself, right? And what do we see? Well, we see the stock market ends up following, the credit spread ratio here, and we see the decline. Over here, stock market making higher highs, while the credit spreads here is making lower lows or lower highs, and we see that the stock market corrects itself for a pullback. And then here, we actually see the stock market making lower lows, while credit spreads are making higher lows, and we see the stock market actually start to rally. Now, most recently, the divergences between these two charts have been playing out on the credit spreads and suggesting that the credit spreads are actually lagging behind, right? What I mean by that is, you see here we're making these lower lows. Meanwhile, the S&P 500 is making higher lows at this time period, suggesting that this should start to rally, and sure enough, it does. And then here we have this divergence where this is making higher highs and the S&P 500 is making lower highs, suggesting that one of these two, needs to correct. And we see that correction in the form of the credit spreads dropping here. So at the moment, we don't have any divergences currently, but I will monitor this. And this is something that you can use as another leading indicator, just like we did with the TIPS and NASDAQ, as well as TLT and S&P 500. Now, the four pillars are very important. The reason that these are the four pillars is because these four sectors of the market are very important to the overall strength of the market, right? So top left, we have XLK. This is tech. Obviously, this is going to be, your most important sector for the stock market, arguably. And then you have SMH right here, which is your semiconductor ETF, which again is arguably one of the most, if not the most important sector in the tech sector, right? So it's a subsector of the tech sector. Then you have XLI right here, industrials. Okay, you really want to see your industrials performing strong, right? If the economy is doing strong, then you should see the companies manufacturing these goods also performing well, right? You want to see those companies doing well as well, not just things like tech stocks, right? So the industrials are very important. And one of the most important classes out of the industrials is going to be your home builders, okay? The home builders, if you take a look, it's very pivotal. And a really good indicator in the economy, as well as potential future performance in the S&P 500. All right, now what we see here, all right, and what we're looking at on our weekly chart, and what I've been showing you guys essentially since I've started showing you the four pillars, is all of these were trapped in overhead supply, right? They were trapped in overhead supply, trapped in overhead supply, trapped in overhead supply. And we mentioned how once we broke through our key support levels here, it was going to be bad news for the market. Now, we haven't broken through in tech, and we haven't broken through in the semiconductors. You can see that they tried to, but ultimately they were able to rebound and close above those levels and are almost trying to break out here, right? Now, one could say that these two are trying to form a cup and handle, right? You have a big cup here, you have a big handle, you have a big cup here, you have a big handle. So we're still seeing relative strength, and we haven't seen a complete breakdown in the tech sector, and as well as semiconductors. Those have more been stuck in that overhead supply and really just consolidating for the next move, whether it's a break above or a break below. But the stock market has had a pretty healthy correction. All right. And a big factor of that is because look at what happened in industrials. Okay. Industrials broke down completely. And also home builders broke down completely. So even though we saw this strength in two of our four pillars, right, the other two of the four pillars completely broke down, and that's not good for the market. Okay, so if you're looking for the market and just want a quick way to measure whether the market has some strength right now, whether it has some weakness, well, you want to look at the four pillars and you want to say to yourself, are all four of these looking bullish at the moment? Are they breaking down? Are they breaking out? And it's a quick way to get a summary of the market and potential, sentiment in the market very quickly. Now, when you zoom into the daily, there's some things here that worry me. Now, the big thing that worries me on these daily charts are these gaps down. All four of these have gaps down to fill. Now, these are much closer. XLI and the home builders, so industrials and the home builders, are very close to filling their gaps down, right? XHB is about $4 away. XLI is like $3 away, okay? And then we have XLK right here. XLK Tech is a lot farther away, okay? It's about $13 away from its gap, and the SMH is about $18 away from its gap. So, the big thing you want to be cautious of, and the big thing that the bears are going to look for if you're bearish is you're going to want to see tech break through its major support level, okay? And you're going to want to see it come down and fill the gaps, okay? And get these gap fills, all right? Now, again, XHB, very close to it, okay? And XLI, also very close to it. And so you're going to look for these to continue and extend their move down, right? And essentially fill those gaps. Now, if these gaps fill, that's going to be a very interesting point in the market for me. And we're most likely going to see the S&P 500, correct even further and have a pretty significant pullback from its current levels if all four of these fill their daily gaps down. Now, speaking about industrials, all right, what we have here is basically the Dow transportation theory, which is something you can look up. And now we have DJT right here, which is the Dow Jones Transportation Average. And then we have DJI right here, the Dow Jones Industrial Average, and the S&P 500. The Dow Jones Transportation Average can oftentimes be a signal to the market. Now, what do I mean by this? Well, when we take a look, the Dow Jones Transportation Average actually hit all-time highs and hit new highs before the stock market did, before the industrials did, before the Dow Jones Industrials, and before the S&P 500. Now, what else happened? Well, it also bottomed out here before the S&P 500. So sometimes the Dow Jones can give you a signal and be a leading indicator for the S&P 500 and the stock market as a whole. And what have we seen in the Dow Jones Transportation Average? We've seen complete weakness, right? We talked about how all three of these in the last video were near support levels. We were wondering if they were going to break down. And if they were, it was going to coincide with some pain in the market. Look at what the transportations have done. So if these are going to be a potential leading indicator, this again is going to suggest further weakness in the market, right? When you take a look at the S&P 500, it broke through its key support level, and it's actually retesting it now. So if it's going to retest and reject, that's going to mean that the Dow Jones was a leading indicator, and we're still going to get continued bearishness in the market. Now, staying on the theme of industrials, right, we have XLI here on top, and we have the NASDAQ in the middle, and we have the S&P 500 on the bottom. And you can see that the NASDAQ, that tech, and when we looked at XLK, tech was looking a lot stronger than the industrials. The tech is the only one that's very close to really breaking out. Now, it just rejected its trend line, and it's much closer than the industrials and the S&P 500. So if we're going to look for an overall market rally, we're going to want to see tech break out of here, and we're going to want to see industrials as well as the S&P 500 break out of their downtrends that they have been stuck in. Until then, the trend is your friend, and we are in a downtrend. Now, when you talk about risk on versus risk off, all right, what we have here is basically, it's basically a bunch of different risk on asset classes put together into one ticker. Okay, so what we have here is copper, high yield bonds, the Aussie dollar, semiconductors, and high beta. It's kind of like my own little ETF, right? So this is more of a risk on ETF. All right, and these are a bunch of risk on asset classes. And then we have risk off asset classes right here. You have gold, US treasuries, the Japanese yen, utilities, staples. Okay, and so we can see here a clear shift in risk off. So the market is definitely going risk off at this time, and we see a huge spike up, right? We see a huge spike up in the risk off index, and the risk on index is actually getting a small decline here. All right, so that's basically where we're at right now, and we could potentially be seeing a breakout in the risk off asset classes. And this again would just suggest that the market is going a little bit more risk off, and maybe we're not going to see the market really embracing risk and going risk on at the moment. Now, this is basically one way that I like to measure if the market is defensive. So what we have is the S&P 500 up here in blue. We have the ratio of our high beta stocks to low volatility stocks. Okay, so as this goes up, it means that high beta stocks are outperforming low volatility stocks, and as this goes down, it means that low volatility stocks are outperforming high beta stocks. And what do we see? Well, we've been stuck in a downtrend, right? Just like the S&P 500. Right here in orange, we have consumer discretionaries versus consumer staples. This has been an area that's actually been holding up relatively well. Okay, when we take a look and we were to look for some potential divergences here, what can we spot, right? Well, we can spot that S&P's in a downtrend here. The high beta to low volatility stocks are in a downtrend, but meanwhile, consumer staples, consumer discretionaries versus consumer staples has still been in an uptrend. That's a little bit more offensive, right? So this one here is showing defensive. This is showing offensive. We have our credit spreads right here also showing defensive in a downtrend. And then we have the XBI here in red. Okay, and the XBI is arguably one of the most risk-on asset classes. So this is also another form of measuring, if the market is defensive or offensive. And you can see here that really ever since the S&P 500 has been range bound and really just stuck in this range here. Okay, really just, stuck in this range essentially, right in through here. We can see that what has XBI done? Well, XBI has not been bullish at all, right? The market has not really gone risk off, and XBI has also been range bound here. Meanwhile, all of the other classes that we're looking at here have been steadily putting in higher lows, right? Higher lows, higher lows. We have here higher lows, higher lows. We have here higher lows, higher lows. So everything else has been making higher lows except for the XBI. All right. And so essentially what we're looking at here is we're looking at 3 out of 4 of our measures for if the market is defensive or defensive. Okay. And the only one that really is offensive or a little bit more bullish is going to be your consumer discretionary to consumer staples. And we'll have to monitor to see if that progresses and continues or if that goes away. Next, we're going to be taking a look at our Skew Index right here. So we have the Skew on top, and then we have the S&P 500 here on the bottom. And this is basically a way to look for potential buy and sell signals. We have the green shaded area here highlighted by all the arrows on the bottom. Those have been really good buying opportunities. So we do want to embrace those. And when we come up to, these 3 levels, and when we're trading around these 3 levels, these are oftentimes where we see the market sell off, So the skew generally will move the same direction as the S&P 500. So as you see the skew going up here, we also see the S&P 500 going up here. And as we see the skew decline right here, we also see the S&P 500 decline right here. If you take a look at the weekly candlestick, it doesn't look as bullish as the skew index, does right here. And we see the sharp move up. So we need to be cautious, though. If we progress up to 146.5, 154.45, those are going to be areas in between there where we may want to hedge ourselves, because those are pretty high levels that we really haven't seen in the market. We've only gotten above there one time in the past 10 years, and so these are the more relevant levels that I pay attention to right now. And once we come up to levels like these, this is where we're generally seeing lots of panic and fear in the market. for some type of reason, right? That the option market is pricing in. So be cautious of that. Again, if this continues to rise, you may want to, start looking at some potential hedges for your positions. So here we have our percentage of stocks above their 50-day and 200-day moving average, with the 200 being in middle and the 50 being on the bottom. These can often provide buy and sell signals based on divergences. There were some divergences here, and those ended up playing out very nicely. Divergences here, those played out nicely. Divergences here, those played out nicely. So I like to look for divergences as well as key levels, right? So essentially, once you see the market come up to, basically 90% of stocks trading above their 200-day moving average, that's going to be a sign that things are potentially getting a little too frothy in the market, and we could be due for a correction, right? And you see a nice little correction here in the S&P. Same thing with the 50-day moving average. Okay, once this gets up around 90%, oftentimes it could be a sign things are frothy, time for a pullback. And when these things get super oversold and are below 20%, that's when you want to potentially be looking for some longs, right? A sign that potentially things are oversold in the market and things could potentially be due for a bounce, right? We see over here, things were very oversold. We had 11% of stocks in the stock market trading above their 200-day moving average, and we see a nice strong recovery afterwards. Same thing here at that time period. We see the percentage of stocks trading above their 50-day moving average is all the way down less than 5%. So extremely, extremely bearish, extremely oversold. And, it was a good buy signal. Same thing when it happened over here. And most notably, recently, we came back down to these conditions where about 10% of stocks in the stock market were trading below their 50-day moving average. And we did see a nice bounce and recovery in the market. But it seems that we are continuing the downtrend and we did not get a sustained rally. We'll have to see if we can turn this into a lower high and try to create a higher high after this. But for now, we're continuing the trend of lower highs and lower lows in the market. For us to see really true strength in the market, you typically want to see the percentage of stocks trading above their 200-day moving average above 50%. And you also want to see the percentage of stocks trading above their 50-day moving average above 50%. Now, as I mentioned, you can find buy and sell signals, okay, above and below those conditions. But in a general sense, you'd want at least half of the market to be trading in what most people often look at for if a stock is bullish or bearish, if it's trading above or below the 50 or the 200-day moving average. Now, these are our market internals. We have the S&P 500 futures here on the right. We have the ADD. This is your advanced decline line. You have your VOLT. This is your volume up, down. And we have our tick here. What we see is that we started the week off a little bit bullish, okay? And, we can take a look here and, things were looking nicely on the VOLT, right? We had a nice little uptrend here and a nice little uptrend on the ad. But since then, they started a downtrend, right? Basically on Wednesday, the tone shifted in the market. Now, why is the internals important, right? Why are these things important for you? Well, this is Wednesday right here, and being that these are futures, these are generally the hours that people are not trading. But you can see when market opens, we get this very strong sell-off here, right? Very strong sell-off. And that coincides here with the internals just keeping this downtrend here on Wednesday, right? The internals keeping the downtrend here on Wednesday. And then we see a strong end of day push, right? And a very strong end of day push. And the market actually makes new highs above where it opened at. Now, how is this and how do we use the internals to potentially spot this huge sell-off that we have afterwards? Well, we want to look at our internals and see if they're justified, right? Typically, when you have the ad up here on the 1500 to 2000 region, that, basically tells you very bullish, okay? And when you have it at negative 1500 to negative 2000, that's very bearish. With your VOLT, all right, it's basically going to be right up here, right down here. These are basically your bullish and your bearish conditions in the market. And so on Wednesday, even though we came in the market and made new highs and had this very strong rally towards the end of the day, what we see is that we're not actually seeing bullish conditions here on the VOLT, and we're not seeing bullish conditions here on the ad either. Now, this is a kind of inference that, hey, maybe we're still in this overall downtrend on the market internals. And if so, we could potentially be due for a huge sell-off, and maybe this was a false rally, right? A fake out, a bull trap in a sense. And essentially that's what we saw, right? And afterwards we get the huge sell-off in the market tries to recover. We start off bullish pre-market here, and then once the market opens on Friday, we get very aggressive sell-off, right? And again, we're seeing a clear downtrend in the market internals here. So these are just some of the different metrics. I like to use these on an intraday basis. And also just take a look at them after markets closed and kind of see. But the market internals will really help give you an edge once you start to learn them and understand them, especially from a day trading perspective, right? I mean, when you're seeing the VOLD going up in a straight line like this, when you're seeing the ad open up in these bullish conditions here, this isn't necessarily the time when you want to be shorting the market, right? I mean, I don't want to go extremely bearish positions right here when I see these really bullish conditions in the market internals. And look at how Tuesday traded, right? It had a huge bullish day right there, very, very big move up. So, these are just some things to consider, all right, and take a look at whenever you're trading, doing some market analysis. And to finish things off here, we have our equal weight on top. So this is the RSP with the S&P 500 on the bottom. And we're seeing a lot of confluence right now. Both of these broke through key support and are retesting that level as resistance at the moment. It'll be very important to see whether or not they reject those levels and continue their downtrend. Same thing here with the equal weight NASDAQ. So we have the QQQE up here on top, and then we have QQQ. And you can see that both of these are just continuing to bounce off of support. Of course, the equal weight looks a little bit weaker, all right, and could be trying to break through support here. Meanwhile, the actual NASDAQ looks a little bit stronger, saw a more significant bounce off of support, and is still in more of an uptrend. And this one essentially finished the week off positive. Meanwhile, the equal weight finished the week off negative. All right. Now, that's it for today's video. Don't forget to sign up for that newsletter. Link is in the description, guys. It's called Investment Intelligence. Really good stuff, straight to your inbox, completely for free. And if you are interested in an options trading class or some type of one-on-one personal session with me where you can figure out how we do trades like this using options, don't forget to check out that Ko-Fi platform using the link in the description, where you can directly book a 30-minute or 1-hour session there by clicking on the commissions tab. All right. And that's basically the best way to reach out to me. And that's now how I schedule all of the one-on-one sessions for, those one-on-one sessions. Thank you guys for watching. Smash the like button, subscribe for more.